Hi, it's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. This week, I thought it'd be good to focus a little bit more on the European economy, since there has been a lot of focus in terms of a new Prime Minister in the UK, the seventh in 10 years, as well as some concern about concentration, particularly in the AI companies of the US, and maybe an indication that that's a sign that there needs to be some diversification within the global economy, and that should bode well for European companies. So with no further ado, let me bring up the slides. I've called this week's podcast Life Support, as there was a wonderful expression in the French media about the French economy having une maladie chronique, and suggesting that it was indeed very sick and the new sick man of Europe, and that needed all the attention, and it certainly has had the attention of the IMF this week. As usual, we will cycle through inflation, interest rates, geopolitics, equity markets and other asset classes. And we're going to speak initially about whether June was indeed inflation's deep fake moment. We know inflation looked particularly low in June, and that gave some confidence to market participants that the central bank's next move would not be upwards. But we're going to dig into some of the energy pricing data and ask whether that was simply too good to be true, and we need to, in fact, still be worried about inflation as we look to the second half of the year. There is a new face at number 10, but there are so many old faces, but at least when it comes to some of the news flow, as we're seeing, again, a focus on AI and some of its issues as it goes rogue, perhaps. But we're also hearing a lot more about tariffs. And of course, the geopolitical situation has not progressed. When it comes to equity markets, we are going to look at how momentum has in fact lost momentum. And then we're going to move on to portfolio implications. So back to the question as to whether inflation in June was a deep fake. What we can see is that UK inflation in June had fallen more than expected to 2.6%. And this comes at a time when there is a sharp focus by the new Prime Minister on reducing the cost of living. We've heard already about a scrapping of taxes on some energy and also home energy bills. We've also seen a cut in the bus fare outside London to £2. So small changes at the margin, but definitely true to the manifesto of keeping things affordable. When it comes to the Eurozone, we are seeing inflation slightly higher there at 2.8%. And the question there is, will that be enough for the ECB to be able to pause? All eyes are remaining on oil. And even since these slides were produced, where I have a headline showing oil rising past $95 a barrel, we now know that oil has surpassed $100 a barrel. There is ongoing saber rattling and threatening of more escalation in the Iranian zone. We've also seen the Strait of Hormuz with virtually no traffic, another true choke point there, and suggestions even that there are skirmishes elsewhere on some of the other major supply chains and further pressure there, therefore potentially on supply. This comes at a time, as we noted last week, that oil inventories are close to record lows. And there's also been some suggestion that natural gas too will come under some severe pricing pressure next year. So a very bleak picture for energy pricing at this stage. And as we can see, crude prices for December and for a year out are rising again. Moving to the UK, we're hearing again about Andy Burnham's first week in the office, so actually the first few days in office. And we've already seen some surprises when it comes to the cabinet positions. While Shabana Mahmood and Ed Miliband had been touted as potential candidates for the Chancellor position, the all-important Chancellor of the Exchequer, it was actually an outside candidate, John Healey, that was appointed, which clearly nobody saw coming, in particular not the prediction markets. This would actually lead me to question as to how much information we can ever get from the prediction markets. It's interesting that they are increasingly cited in mainstream media now as an indication of expectations. And as we can see from something like this, there was no inside information. There was no moving of markets. The markets got it wrong. And in a sense, there was just as much ignorance there as elsewhere. So as far as what markets think of the new Prime Minister, suggesting that the new Chancellor actually shores up confidence because he is perhaps a less radical figure, and radical is not generally desirable in that role, particularly given the volatility we've seen around fiscal confidence in the UK recently. We have seen UK bonds selling off somewhat as the new Prime Minister had taken office. I would suggest that is definitely to be expected in terms of the uncertainty. We've been there before. It's just below the 6% level. We can see that there is clearly not exactly a sense of calm and complacency in markets but equally there has not been sheer outright panic either. When it comes to old faces, we can see that we're still dusting off the same old playbooks when it comes to trade and tariffs. And there was a surprise slapping of a 50% tariff on certain Canadian goods this week, somewhat out of the blue. Again, returning to that old playbook of surprising markets with control. We now, it does seem that this is probably the wrong time to be injecting this kind of uncertainty into markets, given they are still wrestling with the geopolitical uncertainty and its impact on the oil price. Of course, cost already been driven higher by energy. Now, if they're driven higher by tariffs, would that be one squeeze too many? Looking at interest rates, I've already cited the lower inflation numbers in June, suggesting they are misleading and that actually inflation will be higher. The lower number was suggesting that maybe there could be even a rate cut in the future, and certainly that pausing was justified. Currently, given where EU inflation is, markets do expect the ECB not to raise rates until later in the year. We've seen the US Fed pause, and we've also seen the Bank of England pause. So not a lot of action on the interest rate front at the moment. When it comes to recession, I thought it's interesting to compare. So we're looking at a bit of a deep dive into European economies this week in terms of the probabilities of recession. We know that in the US, the probability is down to 25%. That was a slide we showed last week. So clearly quite a bit of confidence, consumer confidence, as well as corporate confidence, bolstered, of course, by a strong stock market. If we turn to, say, the French condition in particular, as I mentioned there, inflation on the Eurozone, 2.8%. France has always been much lower in recent years than the Eurozone, 1.8% inflation there. So certainly they could do with as much stimulus as they could get. An 8.1% unemployment number, so not too high in its relative to its own history, although youth unemployment is significantly higher than that. But it is high when we compare it to, say, the number in the UK or the number in the US, which has perhaps become our new normal, particularly as that also incorporates many of the gig workers and this more flexible working economy. Growth is negative. That's perhaps why France has been put in this special care or intensive care category, needing life support or at least needing some protracted treatment. And as we can see from the stock market chart above, not much movement over the course of the year to date there. Looking a little bit more detail into the woes that France has been experiencing, we can see that the IMF is only seeing modest expansion from the economy in 2026, 0.6%. As the previous chart showed, we're seeing negative growth. When it comes to the budget deficit, that is widening. The IMF is seeing the gap there reaching 5.2% of economic output. Again, this has attracted the attention of the IMF, which is arguably not the kind of attention that any country really wants or needs. Their deficit is the widening and growth slowing. That's under focus by them. So clearly with the upcoming elections too, there is some concern if there was to be a swing to the right, what that would do in terms of the role of France on the world stage, what that would do to alliances, to the globalization that it has participated in. Quite a bit of uncertainty there. As I'll show later, there are some green shoots when it comes to Europe, and that is actually what differentiates it from the US, could in fact be a strength. Moving to equity markets now. So we have continued to see some sharp volatility and moves in markets. I spoke last week about IBM losing 25% of its market cap in one day. And that type of a move, when there is a negative surprise when it comes to earnings and a reveal of customer demand and a projection from that into future demand, we can see that markets are particularly unforgiving. If we look at the sectors that have performed in a way that would be in line with the local macro data, we can see that the banking sector continues to boom. Despite any potential disruption by AI there, instead the banks are benefiting from increased trading volume. They are seeing the activity around both corporate fundraising as well as retail participation all bolster their trading volumes. And remember, of course, that some of them are involved in this IPO activity, capital raising, and certainly the M&A activity that is flowing from some of these quite frothy valuations. Momentum has been heading in the wrong direction. We're seeing semiconductors showing some sudden and sharp falls, as well as when it comes to the AI battle, chips and software has been the clear loser, whereas chips have been the clear winner. Again, that K-shape emerging when it comes to equity markets. There has been a reversal, however, in recent weeks with semiconductors. Sudden and sharp falls have been cited. Some of that is due to technicals. Some of it is no doubt also just due to some rebalancing. Getting onto that technicals theme, there were some very interesting charts this week about what it is that's been driving some of this volatility. We know that the momentum on the way up can also be accompanied by volatility on the way down, momentum on the way down. But this chart from Societe Generale is intriguing because it plots the UK, the Eurozone, APEC ex-Japan and Japan, and the stock volumes in US dollar as a percentage of the global total. So remember, we are not putting the US here in terms of ranking, but clearly the balance of the global total is probably represented by US volumes. So we're not even speaking about the market cap of markets here. We're simply speaking about the volume of trading. And what we can see is a dramatic fall off percentage-wise over the last 25 years from the Eurozone, from the UK, and from Japan in terms of how much activity does it represent as a percentage of global volumes. What we have seen is the APAC, so the Asia Pacific ex-Japan, ticking upwards, but a very notable steady decline from the UK and the Eurozone. And whereas this would certainly align with our experience of lower retail participation, lower equity ownership in general, and just more of a disconnect between Wall Street and Main Street in UK and Europe, we've also seen shrinking stock markets, particularly in the UK. And we know that as the US stock market has grown and single stocks have soared in market cap, that it is a somewhat anomalous situation when we have one single stock represent more than an entire country's stock market. But that's the current situation we're in terms of the mega scalar companies. But I will say that the interesting aspect and observation from this is that those stock markets where there is a high level of mom and pop or retail involvement have tended to show much more volatility, particularly in the momentum names. So we have definitely seen this in Asia Pacific, particularly in Korea. And I'll show a chart later, which we spoke about before, but it indicates just that growth in the single stock leverage ETF. So if that's a representation of the risk appetite there, that is definitely a sign of quite an exuberant and I'd say hot behavior from the individual retail stock owners. Europe looks sleepy by comparison. What we're seeing in Europe is that there is very little trading activity, a fraction of what's seen elsewhere, but this is equally leading to the momentum strategies in Europe being more resilient. And this is an intriguing reality we're seeing here, that even if there is a similarity in terms of the names and the sector across, say, the US, Asia, and Europe, if these names are held in a different way, i.e. if the technical factors are different across the different markets, there could well be very different performance by these stocks. And that would suggest that Europe could be, again, another good diversifier when it comes to the momentum names. The semiconductor stocks are not the only stocks that have been wobbling. We can see that SpaceX has also been wobbling now, trading below its IPO price. And there hasn't been any particular one story here. This could be simply an exuberance subsiding when it comes to SpaceX, perhaps less activity, less frenzied buying. Sometimes this selling and this fall in the stock price sets expectations that the stock price could even be lower. And we've also seen, although this came out after this chart was produced, that Tesla has been falling today on the basis of some concerns around its demand and general decline in the EV sector. We've also seen Google suffer today, as even though search numbers have been strong, the market seems to have very little appetite and capacity to think and absorb further capex charges. So capex being just a little bit too much to bear in that particular instance. Cycling through some other news, I mentioned the volume increasing in the single stock leverage ETF, which has been driving much of the volatility in Asian stock markets. We are still also digesting that news from IBM last week in terms of the idea of the consumer having a limited pocket, not an unlimited pocket in terms of what would or would not be be possible to spend money on, that they had to essentially choose between software and hardware was essentially choose between AI and hardware was not the recipient of that marginal dollar. So that has been, I'd say, sent a chill around the world in terms of AI expenditure, who will be the winners and who will be the losers in that instance. We have also seen some headlines just this week about open AI model going rogue during testing, triggering unprecedented breach at a startup. All of these are slightly worrying indicators, a suggestion that there will be more focus on the regulation, on security of many of these models, and that there could be essentially some choke point that is leads to a slowing down of some of this advances. We've seen a call for what would some deem regulatory capture in this case, and this is continuing to bubble up, as well as news of data centers being held back and the consumer starting to token max and think, as they token max, think carefully about which tokens they're using and for what. So I'd say all of this, when we discuss this around AI, we hear that the really only thing that matters is demand, that there is still a massive demand supply gulf. And in light of that gulf, that we really shouldn't be distracted by some of these natural developments that we're seeing. However, these are some of the developments that tend to cause the jitters in markets and sometimes confidence to subside. So we definitely know that just today, as we're recording this, there has been a subsidence in some of the confidence levels that we're seeing. So that is it for this week. Thank you very much for joining us for this deep dive onto some European economic indicators. I look forward to seeing you next week. Thank you for listening to the Markets Happy Hour podcast.